Hello everyone and welcome to the Investing Fuse. In this video we're going to learn all about stock splits. The details we'll go over in this video include what a stock split is, how a stock split works, different examples of stock splits, why companies do stock splits in the first place, the different types of stock splits and their implications, the advantages of stock splits, the disadvantages of stock splits, and what happens if you own shares that undergo a stock split. Now let's get started. So what exactly is a stock split? A stock split happens when a company increases the number of shares in order to increase a stock's overall liquidity. Although the number of shares outstanding increases by a specific multiple, the total dollar value of all shares outstanding remains the same. This is because a stock split does not fundamentally change a company's value. The most common split ratios are 2-for-1 or 3-for-1, sometimes denoted as 2-1 or 3-1. This means that for every share held before the stock split, each stockholder will have 2 or 3 shares after the split. So how does a stock split actually work? A stock split is a corporate action performed by a publicly traded company in which the company issues additional shares to shareholders, increasing the total amount of outstanding shares by the specified ratio based on the shares that were previously held. This is done by dividing each share into multiple ones and reducing the stock price by the ratio amount. It's important to note that a stock split does nothing to the company's market cap. The market cap remains the same, much like when a $100 bill's value doesn't change when it's exchanged for $2.50s. So with a 2-for-1 stock split, each stockholder receives an additional share for each share held, but the value of each share is reduced by half. This means that 2 shares now equal the original value of 1 share before the split. Let's take a look at the following example below in order to get a better understanding. Let's assume that XYZ stock currently trades at $200 per share and has 100 million shares issued. This gives it a market cap of $2 billion, 200 times the 100 million shares issued. The company then decides to implement a 2-for-1 stock split. This means that for each share shareholders currently hold, they receive another share. They have 2 shares for each one previously held, but the stock price is cut by 50% from 200 to 100. Notice, however, that the market cap stays the same, doubling the number of shares outstanding to 200 million while simultaneously reducing the stock price by 50% to $100 a share for a market cap of $2 billion. So the true value of the company hasn't changed at all. So why do companies split stock in the first place? Companies often choose to split their stock to lower its trading price to a more comfortable range for most investors and to increase the liquidity in its shares. Most investors are more comfortable purchasing, say, 100 shares of a $10 stock as opposed to 1 share of a $1,000 stock. So when the share price has risen substantially, many public companies end up declaring a stock split in order to reduce it and make it more attractive for investors. Although the number of shares outstanding increases in a stock split, the total dollar value of shares remains the same compared to with the pre-split amounts, because the split does not make the company more valuable. In order to get a further understanding of stock splits, let's take a look at different types of stock splits and their implications. A company's board of directors can choose to split the stock by any ratio they see fit. For example, a stock split may be a 2-for-1, a 3-for-1, a 5-for-1, a 10-for-1, and even a 100-to-1. A 3-for-1 stock split means that for every 1 share held by an investor, there will now be 3 new shares issued. In other words, the number of outstanding shares in the market will triple. In addition to different stock ratios of splits, a company can elect to do a forward stock split or a reverse stock split. Forward splits are the most common type of stock split. For example, a common stock split ratio is a forward 2-to-1 split, where a stockholder would receive 2 shares for every 1 share owned. This results in an increase in the total number of shares outstanding for the company, though no change in shareholders' proportional ownership is changed. On the other end, we have a reverse stock split. A reverse stock split is performed by a company in order to boost its stock price by decreasing the number of shares outstanding. A reverse stock split has no inherent effect on the company's value, with the market cap remaining the same after it's executed. This path usually is pursued to prevent a stock from being delisted or to improve a company's image and visibility. During a reverse stock split, a company cancels its current outstanding stock and distributes new shares to its shareholders in proportion to the number of shares they owned before the reverse split. For example, in a 1-for-10 reverse stock split, shareholders receive 1 share of the company's new stock for every 10 shares that they owned at a new price. In other words, a shareholder who held 1,000 shares would end up with 100 shares after the reverse stock split was completed at a price that is 10 times higher than the original. So what are some of the advantages of stock splits? A stock split can make the shares seem more affordable even though the underlying value of the company hasn't changed. It can also increase a stock's liquidity. When a stock splits, it can also result in a share price increase, even though there may be a decrease immediately after the stock split. This is because small investors may perceive the stock as more affordable and buy it up. This effectively boosts demand for the stock and drives up prices. Another possible reason for the price increase is that a stock split provides a signal to the market that the company's share price has been increasing. People may assume this growth will continue in the future, and this further lifts demand and prices up. It's worth noting that stock splits also come with their own set of disadvantages. Not all facets of a stock split are meant to benefit a company. The process of a stock split is expensive, requires legal oversight, and must be performed in accordance with regulatory laws. The company wanting to perform a stock split must pay a great deal of money to have no movement in the market cap value. It's also worth noting that a stock split isn't worthless, but it doesn't impact the fundamental position of a company and therefore doesn't create any additional value directly. Some compare a stock split to cutting a piece of cake. If the dessert tastes horrible, it doesn't matter whether it has been cut into 10 pieces or 20 pieces. Some opponents of stock splits view the action as having the potential to attract the wrong crowd of investors. Consider Berkshire Hathaway's Class A shares trading for hundreds of thousands of dollars per share. Had Warren Buffett split the stock, many traders and the general public would be able to afford its company shares. Instead, to maintain equity ownership as exclusive, a company may want to intentionally not split its shares. Lastly, there are implications for intentionally reducing a company's share price. Public exchanges such as the Nasdaq require stocks to trade at or above $1. Should a share price drop below $1 for 30 consecutive days, the company will be issued a compliance warning and will have 180 days to regain compliance. Should the company's stock price still not meet minimum pricing requirements, the company risks being delisted from the exchange. Let's take a look at what happens if you own shares that undergo a stock split. When a stock splits, brokers will credit shareholders with additional shares, which are reduced in price depending on the ratio split. For instance, let's assume you're undergoing a 2-for-1 stock split and you owned 100 shares that were trading at $50 a share before the split. With the split, you would then own 200 shares at $25 a piece. Your broker would handle this transaction automatically, so there would be nothing to do on your end. We hope you've enjoyed this video and now have a better understanding of stock splits. Let us know what content you would like to see next, and please smash that subscribe button.